Hello and welcome to our latest Insider interview. Today in the studio I have with me Stephen Lilly, Fund Manager of Greencoat UK Wind. Stephen, thanks for coming in today.
Very welcome.
So over the past decade, Greencoat UK Wind has achieved its dividend target of growing the income in line with RPI inflation. And the underlying investment performance, so the net asset value, has also beaten RPI inflation over that period. So what are the prospects for the next decade? I mean, could it potentially be an even better period for the trust, given that we're going through a transition towards a global green economy?
Yeah, no, you're right. We set out 10 years ago to have a dividend that always increased with RPI. That's how we designed it, and that's why we started off at 6p. And to preserve NAV on a real basis, which we've done at, I think, 69% versus 46% of RPI compounding. I'm not sure I can necessarily guarantee that we're going to do that again, but we are in an environment where there is substantial growth. I think the nice thing, I guess, is that in 10 years, politics has come towards us, if you like. So it doesn't go back to the days of say Vince Cable, who we had sign off a £50 million investment into our IPO. All parties are very much behind what we're trying to do. But the nice thing, I guess, from going from probably from here through to £200 billion of assets, not 100 but 200 by the time we get to the end of the decade, is that we're of a size and significance that actually we can play and we can be quite significant. So a lot of the talk at IPO and Vince Cable required this, I guess, is to have the money that went back to IPO, RWE and SSE recycle back into building offshore capacity. That recycling story is as valuable now as it was 10 years ago. And actually a lot of the build out going from 100 to 200 is almost all of it is offshore. So it's even more relevant. And because we've got such a big balance sheet by now, we're capable of moving large volumes of capital and actually being quite significant. And the benefit of being able to do that is not many people can, and therefore we can get some good value in investments. So we're really excited about the next little while. Reinvestment is really there, if you like. There's a lot of capacity that we could buy. The real frustration today, I guess, is given we're trading at a discount, we can't raise equity very easily, so we're stopped from doing that. But hopefully we can get the proper stories across, people can understand what we are in terms of return, and we can continue that sort of pathway forward.
So for investors looking at exposure to renewable energy infrastructure, there's other options such as solar, hydro, energy storage. So how would you make the investment case for Greencoat UK Wind? Yeah,
so we think that investors should look at all, actually, because I think there's a need for capital across the sector. How we'd characterise, I mean, you can't expect me not to be biased here, so I'm going to give you probably, and investors can take their own view of the validity of the argument. Solar is more commoditised, if you like. There aren't massive solar parks. There are massive wind farms. I mean, we bought one recently that's £50 million, Dalcandy up near Glasgow. We also invested 400 million out, but because there was debt there as well, basically an EV of 1.1 billion last year. So we did both of those, and South Kyle will come in shortly at 300 to 400. So those are big assets. Solar farms aren't quite like that. So actually, a lot of the solar funds are competing against each other. There isn't the same type of big, small, and it's more commoditized, if you like. So we think that probably drives returns down on solar as a consequence of that. I think the solar funds have probably got some thing to do about looking at cost of capital, and we've always been massive believers in the capital asset pricing model. How can you not be? Because ultimately investors don't have to do anything like this. They could do something completely different, and therefore against the risk-free rate is really important. So we very much cared for our discount rate and return from the last 10 years, but over the last little while, as interest rates have gone up, really cared for that, and our discount rate's gone up substantially. We think in the solar sector there's probably a need for them to address that fact, and that's probably some of it is to do with why they're trading at a discount quite substantially. So I think there's that, but actually solar assets are good assets. as long as they're priced properly, no reason why people shouldn't do that. In terms of things like battery storage, we think that battery storage is relevant. It's not really infrastructure in the sense that it's not really reliable 30-year cash flows. There are ancillary services that batteries can do, you know, for instance, voltage regulation or reactive power, but we can also do that inside the turbines as well. So yes, they can get paid for that. Is it really long term? Can you really arbitrage markets long term? Not so easy. So yes, investors should look at those, but it's a different thing. It's not a 30-year income stream, so they should look at them, I think, differently. So I would debate whether it's infrastructure.
There are also some investment trusts that invest in a mix of renewable energy. So I've heard the argument that some have exposure to both solar and wind, so that they're benefiting from when the sun shines and from when the wind blows, so they're benefiting throughout the whole year. What do you make of those approaches?
If you want to invest across technology, choose two businesses. You know, we have the best wind management team in the sector. Not Lawrence and I. I think we're okay at what we do, but actually the engineers that sit inside the manager, not subcontracted outside, but actually who cares, because they are in the manager. We think having that expertise is really important. So the focus and the drive, knowing what's happened at every single turbine, when we're on co-investments with utilities, actually telling them a little bit about some things that we should be doing, and they value that as well. They value that cross-fertilisation. So there is a great benefit in being experts, I think. And anyone who says they're an expert of everything is arguably an expert of nothing. Arguably. People may disagree with that.
The renewable energy infrastructure sector, it's been under a bit of a cloud of late due to interest rate rises going up. Yeah. So this has caused a repricing of risk assets. Right. So how has that impacted the valuations of your investment trust?
Well, it's impacted valuations. It's also impacted share price. And I think the share price, I mean, for me, it means that the market isn't particularly efficient, and it's why actually all of our management team, as people may have been able to see in terms of RNSs, and actually half the board as well, has been buying shares. So I think it's grossly underpriced. Obviously, that's a sales pitch, but you can see that in our money has gone where our mouth is in this. We bought a fair bit of stock over the last few weeks. In terms of the value, so we can't, in one sense, we can't do much about the share price. We can do something about the NAV, and we can talk about, like we're doing this morning, some of the messages and the relevance on those messages. But in terms of the NAV, we have, over the last year, taken the discount rate quite substantially, because we do believe in the capital asset pricing model. How can you not? Therefore, our NAV will have come down from that. The fact that our NAV has not fallen in the last year is because we've had massive cash generation. And so, to some extent, we used as I think it was George Osborne who talked about fixing the roof while the sun was shining, or the fact that people didn't. We did last year. We took the benefit of high cash generation to fix the roof, so that as NAV would go up because we just had cash coming into the business, we also took the discount rate up quite substantially, so that as we get to this point in time, we think that our net asset value is actually very good, and the assumptions in there are very strong. And as long as we get to explain the return, as we've talked about a few times in this conversation, we should compare well with other things that people can buy. So if there was an efficient market, people would look at our NAV and think, actually that's okay, I should buy at that price.
And as you mentioned, Greencoat UK Wind, it's trading on a discount. I think over the past couple of years, you've typically traded on a premium. So is those rises in interest rates the reason why you're trading on a discount?
Actually, we've been trading at a premium for 9.5 years. It's not just 2. But yes, for the last 2 years we have as well. But for the last 6 months, probably, yes, it probably is about interest rates. There are other things that in our half-year results, what we've done with where our refinancing risk, actually, that's all sorted, and we'll be able to talk about that in our half-year results. Same with power prices, as we sort of said, that if power prices were 0 for the next 5 years, we still pay the dividend, etc. So that's all pretty straightforward. So we're going to talk about that in our half-year results. But it would appear, yes, that as interest rates have gone up, the sector in general hasn't responded as quickly as we think it needed to. In other words, they haven't fixed the roof while the sun was shining last year, as we had the ability to do. And therefore, I think the whole sector's off. And is there some contagion, if you like, to us? There is a little bit, probably. And all we can do, I guess, is explain what we are. And so, yes, discount rates are moved in a certain way, but actually, if we can talk about return, and it's not just people buying on a dividend yield, but they've actually got that reinvestment as well. If we can talk about that, then hopefully we should, in an efficient market, explain and return back to a premium.
You mentioned earlier that some board members have been buying shares recently. Has the board been proactively buying back its own shares to try and rein in that discount?
Yeah, we've had one or two questions from shareholders about that. It's something that will be in our armoury. We haven't done it yet. We're hoping that with the half-year results we'll be able to explain and actually have some benefit from that. So for most of the time, the last 6 months, we were trading at a very small premium, very small discount. Now it's a bit bigger than that, so it becomes more relevant, I guess. One or two shareholders have said, would you do that? And we are in active dialogue with the board, about that. I think at this point in time, we want to have a chance to explain it first. I think at some point we might do that, because ultimately, there's a lot that can be done in that area. But having said that, actually, there's quite a few things that we might look at buying, and we might recycle assets, and there's a bit of that we're sort of trying to work out what is the right way through the next little while. I think that the first thing we want to do is just have a chance. It's why we're really we can't wait to get to 27th of July and go through our half-year results and go through all those messages and hopefully nail some of those things and have and if you believe in an efficient market, hopefully they will get nailed. And people understand that, but hopefully we can do that. And then the other things like selling assets, buying assets at a discount, buybacks, start to come onto the agenda if we can't solve it by explanation.
And do you personally invest in Greencoat UK Wind?
Yeah, as with Lawrence as well. I think we own somewhere between £750,000 and £1 million worth of shares each.
Stephen, thank you for your time today.
Thank you.
That's it for this episode of our Insider Interview series. You can check out the rest of the series on our YouTube channel, where you can like, comment and subscribe. Hopefully, see you next time.